You know, there's a reason I wore the Berserker helmet today, because it's just another one of those days. Those days where we look at our stock portfolios and wonder, why are we still here? Okay, so the jobs report this morning, it didn't help at all. There are fears that we still have another 50% to go, as potentially inflation remains quite sticky and the Fed continues to hike quite aggressively. We do have some Fed speak to cover, and that gives us a little bit of a guide, and the first time we've actually heard the potential, though, of a 25 basis point softening hike by December. That could also potentially lead to a split Fed. And in this video, I really want to address the potential that maybe, just maybe, the U-turn in markets will come, but just a little later than expected. And we'll talk and we'll look at particular data regarding what could happen in the first quarters of next year. Let's talk about that after we start with Fed speak. So, what did we hear from the Federal Reserve today? Well, the Federal Reserve had two individuals talk today. Mr. Barkin talked about having to be more deliberate, as when you have your foot on the brake, it becomes a little bit more difficult to drive. And I could see that, kind of tense up when you got the foot on the brake, right? It's an interesting analogy. But they do suggest, or he suggests that probably it's going to be time to slow the pace of rate increases, but we might end up at a higher endpoint. And this is something that obviously we've known over the last few days, that what's happening is the curve of how high markets think the Fed's terminal Fed funds rate, terminal just means that endpoint right here, how high that level goes is what markets are trying to figure out. Before the Federal Reserve's meeting, we were right around that 5% level, 5.05, and it's moved up a little smidgen, and because of that, we've seen the steepening of the curve here on the left. This right here, this segment, means more pain in the short term, and that short term is really going to be the next 6 months, right? You could see this peak probably not coming until May of 2023, and so markets are now pricing in that peak here at May, but now the difference is going to become, how flat is this curve going to be? In other words, a curve like this kind of represents a nice decline in rates of maybe about 50 basis points by the time we get to the end of 2023. But what if the actual pace of that curve is much more like this, where we barely have a move down until potentially mid-2024? That would be a little bit more scary, and right here, all of this difference right here would be pain for the stock market and compressing valuations. So the flip side, of course, is this potential that maybe inflation will come down quicker than expected, though there's been no sign that that has been happening, and there's really little evidence that we could point to say, oh yeah, it definitely will happen, though there is no shortage of hope, and it is a possibility. And in that sort of event, if we do see inflation fall, we'd see a curve that could potentially look a lot more like this. And then this right here would likely represent excess returns to stocks rather than excess pain to stocks. So this curve is the most important aspect. And this idea of slowing down the pace of hikes in December really just does this right here on the curve. You could see that here. See, that's what a slowdown looks like. And markets want to see that, so we get off of this insanely quick movement over here that we're seeing. So Mrs. Collins also came out this morning from the Federal Reserve and gave us a little bit insight. She suggested, she was actually the one who mentioned 25 basis points as being a possibility. Her particular quotes were, including 75, and certainly including 25. I thought that phrase was very interesting, that she says, and certainly including 25. She's the first one to say that we could potentially be looking at 25 basis points in December, though I think that's really going to be predicated on the next two CPI reports. Break-evens have started trending down again since the Federal Reserve's meeting, which is good, but we still haven't seen that meaningful decline in that lagging inflationary reporting, which is a problem, because it just means the Fed's going to keep being a little, rigid. Presently, we are pricing in the potential for the Federal Reserve to raise rates 50 basis points at a 43.2% probability And we're pricing in a 56.8% probability that we're going to get a 50 basis point hike. So you're actually seeing greater odds in the Fed futures market right now of us getting that 50 BP hike, and no odds yet assigned to 25, though today's the first time we've actually heard about 25, and it comes on the jobs report day, which that jobs report just wasn't phenomenal, much stronger hiring than we expected with revisions to the upside. Though, something that could actually lead to a lot of bullishness in the markets is the following chart. Ready for this? Look at this. This chart right here is a chart we're going to look at right after I mention our sponsor today, Streamyard. Guys, I've been using Streamyard for years now, and I seriously love it. Streamyard is the easiest way to create content right from your browser. You can multi-stream to social media platforms like Twitch, YouTube, Facebook, and more. You can host a weekly show with special guests, create webinars, record podcasts, create videos, and more. You can do it all live and download a recording directly from the app, and trying to get videos out on topics like the stock market, quite frankly, requires a fast turnaround. And that's why you should go to metkevin.com/StreamYard. See, for me, without StreamYard, it just wouldn't be possible for me to get out as many high quality videos as I do, especially live streams. They also make it easy to brand and customize your videos before you even go live. StreamYard's a very popular tool amongst live streamers, video creators, YouTubers, and podcasters, and they make it simple to get professional, polished content out every single time. Personally, I love putting comments up on screen when I'm live, so really, really love that. So make sure you go to metkevin.com/StreamYard and get started today. That's metkevin.com/StreamYard, or use the link in the description down below, because after all, StreamYard makes it simple to get professional and polished content every time. This chart right here shows that the trajectory of payroll growth, especially when you align it with the Conference Board's leading indicator index, which tends to always precede falls. Okay, so let me explain that quickly. The blue line goes down, and then the black line tends to go down. And there are sort of various moves here, right? Sometimes you see them go down at the same time. Often you see the blue line go down first, and then the black line goes down. See, blue line peaks first, and then you kind of see a little bit of a decline here. Blue line goes down here. You see the black line go down over here. Blue line goes down first. You see the plummet in the black line. And look at what we have over here on the right side. That's the most interesting side, obviously, because that's the now. We have leading indicators suggesting that the rate of employment growth is plummeting, and it's about to go straight to zero based on the Conference Board's US leading index. And this is where you have Bloomberg suggesting the following. Payroll growth is headed to 0% by Q2 of next year. Now, that's unfortunate for the Santa Claus rally, but it actually kind of lines up with post-midterm election rallies. How interesting is that potential? Look at this, folks. This is a chart from Citibank, and Citibank tells us that after midterm elections, we tend to go green, like on average, all the frickin' time. In all scenarios, we tend to go green. But look at the difference. You look at the S&P from October 31st to year end, and then the S&P a year after the election. Most of the returns happen in the year starting January, and then the rest of the year. In fact, look over here. If you just do, we go over here, House and Senate split or any kind of gridlock, you only get about 1 to 3% of returns towards the end of the year. Most of the returns actually come in the following year. So after January is where most of the returns come on average. To see that graphically, you look at this particular chart. You see here, this election point right here, you see some nominal gains towards the end of the year, but most of the gains actually seem to occur in the next year following January 1st. Now, this is pretty remarkable because when we combine this historical election chart with peak Fed rates, probably in Q2, and you combine it with potentially peak payroll in Q2, we might actually have some freaking finally light at the end of the freaking tunnel. This is really, actually, in my opinion, exciting because Q2 begins in 5 months, folks. We're 5 months away from Q2. 5 months gives us 5 more CPI reports. And that, in essence, means we probably have about 5 months left of getting our positioning ready before probably some real more sustained market movements to the upside. Now, no guarantees that we'll be at bottom in Q2. The bottom could have already happened. We could be at the bottom today. We could be at the bottom tomorrow. Actually, we can't be at the bottom tomorrow because tomorrow's Saturday. But the point is that Q2 is lining up really nicely when you look at payroll growth, CPI lapping really high inflationary numbers from the beginning of the Ukraine disaster in February and March at the end of Q1, right? We'll see those numbers more in Q2. Again, payrolls, election, CPI lapping, and here's the other thing to consider. This is a big one. Remember that jobs reports lag what actually happens in the job market. In fact, we had price cuts over at Tesla in China on October 24th. Those numbers don't really show up in Chinese vehicle deliveries. So the deliveries that we got at the beginning of November, really, the report that we got for October doesn't really anticipate those price cuts or include those price cuts yet. So that similar kind of phenomenon is true of jobs as well. We just had a ton of companies from Apple to Amazon freezing corporate hiring to layoffs at Lyft and many dozens of other companies, whether they're financial, tech, or otherwise. They're all laying off people. All of those layoffs were really being announced after companies announced their earnings reports, or in the case of Open Door, slightly before. And what's remarkable about that is none of those layoffs are going to show up in the employment jobs report of October, especially since those reports usually are based on surveys that are conducted on the second or third week of the month, which even if they were conducted at the third week of the month, that was basically right as earnings season was beginning, and most of job cuts were announced after that. So you've got a lagged report over here. And over the next 5 months, I don't see a reason why, when we combine the fact that companies are slowing, companies are seeing the headwinds. Look at Cloudflare. This morning in the course member live stream, we went through the Cloudflare earnings call. And all you have to do is look at their macro arguments that their customers are starting to see real pain. They're extending how long they're taking to actually make contract decisions. And look at this line. The CFO says there's nothing in their Q4 and Q1 outlook to indicate that anything's going to be getting better anytime soon. Instead, that things are getting worse in terms of their sales. But ironically, things getting worse for Cloudflare is actually good for helping jobs get depressed and inflation to come down. So that's what we want to see. Now, this is all just becoming a big game of how long can you last? Can you make it to Q2 without capitulating? Can you make it through market pain, realizing that the pain we're experiencing is based on macro and the Fed and not necessarily on your underlying investment? You know, if you're shorting, you're cheering. You might not even be watching these videos, but then you'd be walking into a blind spot of what could be coming at the beginning of next year. And those sort of changes could start getting priced in as soon as our CPI report potentially next week, if we start getting some optimism on that. Of course, if we get a bad CPI report, everything just gets delayed more, right? That's all what happens. The more we get bad reports, the more this crap just gets delayed, and the longer the pain lasts, and the longer we have to wait to get back to a real sustained market rally. So we have to be careful, but the writing is on the wall for big changes coming here. And they're exciting, but unfortunately the wait is agonizing. So if you feel pain, totally understandable. Thanks so much for watching. Hopefully this was insightful to you. I think it's bullish for Q2. I wish it was bullish for the Santa Claus rally. It could be slightly bullish, but we're just not there yet. It's all lasting a lot longer than expected. And yeah, that's what she said.